Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of what companies are trying to hide or what they are bragging about. Today we are diving into a filing from Nuburu Incorporated, and let's just say things are getting interesting with some big deals and strategic moves. Before we dive in, if you find value in breaking down these complex financial documents into plain English, please hit that subscribe button. Also, we have a fantastic community over on Discord where we discuss these filings, and more. You can find the link in the description. So, what is the big story with Nuburu Incorporated? They are making some significant moves, investing in defense and security and swapping out some serious debt. Let's break it down. Let's start with a major investment. On the 6th of February, Nuburu entered into an agreement to buy shares of Heckler & Koch. Now, Heckler & Koch is a big name, a leading maker of small firearms for NATO and European countries. Nuburu acquired about 0.8% of their outstanding shares for a chunky sum of $15 million. This wasn't paid in cash though, but through a special type of loan called a subordinated convertible note. This note is set to mature in March of 2027 and doesn't bear interest unless there is a default. The conversion price is set at $0.1515 per S-share, which was the average price of Heckler & Koch stock on the day before the deal was signed. There are some limits on when this note can be converted, especially if it means the original lender ends up owning too much of Nuburu's stock, or if Nuburu needs to get approval from its shareholders, or increase the number of shares it is allowed to issue. It is also subordinate, meaning other debts get paid first if something goes wrong. Nuburu plans to file paperwork by April, so these shares can be resolved. Next up, a move to clean up some existing liabilities and get back in the good graces of the NYSE's stock equity rules. Nuburu signed an exchange agreement with Indigo Capital LP where they are giving Indigo a pre-funded warrant. In return, Indigo is transferring 844,938 shares of Nuburu series, a preferred stock, back to the company. The warrant allows Indigo to buy a lot of common stock, specifically 55,771,485 shares for a ridiculously low price of $0.0001 per S-share. This number of shares was calculated based on the average stock price the day before the agreement to prevent Indigo from gaining too much control. Nuburu won't sell them shares that would push their ownership above 4.99% of the company's total outstanding stock. This warrant is good for 3 years, expiring in February of 2029. Essentially, they are swapping out preferred stock, which can be a burden for a warrant that gives them more flexibility moving forward. Now, let's talk about an amendment to a deal that has been in the works. Back in October of 2025, Nuburu agreed to buy an Italian company called Orbit SRL. The total price for Orbit was $12.5 million, some paid in cash and the rest in securities. Originally, the non-cash part of the deal, worth $8.75 million, was supposed to be paid in convertible preferred shares by the end of 2026. However, on the 9th of February, they amended the agreement. Instead of issuing preferred shares, Nuburu will now issue 50 million shares of common stock to complete this part of the acquisition. This change is important because Orbit is indirectly owned by Alessandro Zamboni, who is Nuburu's executive chairman and Chief Executive Officer. This makes it a related party transaction, and it has been reviewed and approved by Nuburu's independent directors and audit committee. This simplifies the payment structure and potentially reduces future dilution from preferred stock. These agreements, the Heckler & Koch investment and the transfer of preferred stock, along with the Orbit amendment, are all part of bigger strategic moves. The filing essentially confirms these transactions are moving forward. The new notes and warrants mentioned in the earlier sections are part of the company's financial obligations. So these filings are essentially detailing how the company is raising funds, making investments, and managing its financial structure. This section basically says that the shares being issued under these new agreements are not being registered with the SEC in the traditional way for public sale. Instead, they are being sold in private transactions, which is common for these types of corporate deals. Now, like most filings, this report includes a section on forward-looking statements. This is basically the company's way of saying that their future plans and expectations might not turn out exactly as they predict. They warn that many factors, including market conditions, regulatory changes, and their ability to access capital, could cause their actual results to be different. It is a standard disclaimer. But it is important to remember that when companies talk about future plans, there is always uncertainty involved. They highlight specific risks like meeting NICE listing standards, the impact of losing their patent portfolio, and their overall acquisition strategy. So what is my take on all of this? Nuburu Incorporated is definitely making big plays. The investment in Heckler & Koch shows a clear strategy to build out their defense and security platform, which is a growing sector. Trading preferred stock for a warrant with Indigo Capital is a smart move to simplify their capital structure and reduce potential liabilities, especially if they are struggling with nice equity requirements. The amendment to the Orbit acquisition swapping preferred stock for common stock also streamlines that deal, though it does mean more potential dilution down the line. The core strength here is the aggressive pursuit of strategic acquisitions and partnerships that clearly align with a defined business direction in defense and security. They are trying to position themselves for growth in a specialized market. However, the risks are significant. The reliance on shareholder approval for certain conversions and the mention of potential issues with NICE listing standards suggests that financial stability and market confidence are still areas of concern. The mention of losing their patent portfolio is also a major red flag. Their overall success hinges on executing these complex deals smoothly and managing the resulting financial obligations and potential dilution effectively. In conclusion, Nuburu is in a period of significant transformation, actively restructuring its finances and making bold strategic investments. Whether these moves will translate into long-term success remains to be seen, but they are certainly not playing it safe. Alright, that is our breakdown of Nuburu Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more great discussions. Thanks for watching, see you next time.